If you had 10,000 to invest in the stock market, what would you choose? Buy shares of a company, invest in funds, or trade in derivatives? They all sound like approaches to invest in the stock market, but each one works very differently. Let's break them down so they are easy to understand. Shares are like owning a small piece of a company. Imagine buying one shop inside a big shopping mall. Your profit depends on how well the whole mall is doing. And funds are when many people pool their money together to invest. It's like a group of friends buying the entire building instead of just one shop and hiring an expert to manage it. While derivatives are not about owning, they are about predicting price movements. You are basically betting on whether the price goes up or down, and your profit comes from being right. So, what's common among shares, funds, and derivatives? All three can be bought and sold through the stock exchange, usually using your brokers or trading app. And in all cases, your returns depend on how the market performs. When prices go up, your investment gains value. When they drop, you may face losses. So here is how they differ. Shares give you direct ownership in a company. Funds give you indirect ownership. Derivatives, you don't actually own anything. Risk wise, funds are usually safer. Shares are moderate and derivatives are high risk. When it comes to returns, shares can go low or high depending on the company. Funds are steady and moderate, and derivatives can swing from very low to really high. And for knowledge, funds are easy to understand. Shares need a bit more research, and derivatives need serious market know how. Now let's quickly look at the different options under each investment type. For shares, we have common shares or shares of a company you directly own, preferred shares, and IPO shares. For funds, there are mutual funds, ETFs, hedge funds, pension funds, and sovereign funds. And for derivatives, we have futures, options, forwards, and swaps. Sounds like a lot, right? Don't worry. In later videos, we will dive deeper into each option so you can understand them fully. Here is the filter list showing the most common ways people actually invest in the stock market. And if we sort them, starting with the easiest options and moving up to the most advanced ones. So let's start by understanding mutual funds a bit more. Mutual funds are the simplest way to invest. You, along with many other investors, give your money to a professional fund manager who invests it across many companies for you. Of course, that fund manager doesn't work for free. They charge a small fee for managing your money. Think of it like joining a bus. Instead of driving your own car, the driver takes you to the destination, but you share the ride with others. There are many types of mutual funds out there, like equity mutual funds, index funds, debt funds, and many more. Each one is designed with a specific strategy in mind, and usually you can tell that just by the name. For example, an equity mutual fund invests in top companies depending on the country where you buy the fund and the fund's own strategy. Once you understand which type of mutual fund fits your goal, the next step is buying it, either through fund houses or brokers app in your country. Let's move on to ETFs. ETF or exchange traded fund is quite similar to mutual funds. They also invest in many different companies. But here is the key difference. Unlike mutual funds, most ETFs don't have a fund manager to make active decisions. Instead, they usually track a market index automatically. For example, the S&P 500 ETF follows the S&P 500 index. When the index goes up, the ETF's price goes up too. Because everything runs automatically, the fees are much lower. You still pay a small management fee, but it's usually just a fraction of what mutual funds charge. And the best part, just like regular shares, ETFs are traded on the stock exchange. So you can buy or sell them anytime during market hours, just like a share of a company. Now let's move on to common shares. In common shares, you buy shares of individual companies yourself. You decide which company shares to buy and when to sell. It gives more control but also needs more knowledge. For example, buying 10 shares of Amazon through your trading app means you directly own part of that company. Finally, the most advanced part, futures and options. They sound complicated, but let's keep it simple. Futures are contracts, like making a deal today for a future date. For example, if you expect Apple's share price to rise, you buy a futures contract at $100. After a certain period, if the price goes up to 120, you profit $20. If it falls to 80, you still have to buy at 100 for a loss of $20. Options, on the other hand, give you the right but not the obligation to buy or sell. Say you buy a call option on Apple at $100 and pay a $5 premium. After a certain period, if the price rises to 120, your profit is $15 per share. 20 gain minus 5 premium. If it falls to 80, you can skip the deal, losing only $5 premium. In short, futures lock you in, while options give you a choice with limited risk. So, to summarize, mutual funds and ETFs are great for beginners with less risk. Common shares suit those who like control and analysis with moderate risk. Futures and options are for advanced investors who understand the market movements with high risk. Whether you choose shares, funds, or derivatives, remember the key is not to pick the most exciting option, it is to pick the one that fits your requirement and knowledge. If this helped you get an understanding of stock market investment types, make sure to like this video and subscribe to our channel.